What's up, everybody? Today, I want to share with you a company that I just bought. I want to go over my thesis for it, why I think it will be a good investment. And in fact, someone else bought this company recently. Tether Holdings, the parent company for Tether, the cryptocurrency, the world's largest stablecoin. They just bought a majority stake in this company. So let's get into it. The company is AGRO. The ticker is AGRO, and they are a South American agricultural company. So that might sound pretty boring. We're not going to be talking about semiconductors or AI or anything like that today. This company, their segments are sugar, ethanol, and energy, crops, which this is kind of like soy, wheat, peanuts, rice, and then all sorts of dairy products, milk, yogurt. Now, if you're bored already, I understand. This is not the technology of the future. You might be wondering why Tether bought this company, but sometimes the most boring investments can be the best ones. And personally, I love boring companies that just produce money year after year after year. This company controls a lot of land and produces a lot of products. You can see a quick overview here. They have 210,000 hectares that they use for sugarcane farming and production. Now, if you don't know, a hectare is roughly about 2 American football fields. So this is quite a bit of land. 240,000 hectares in Argentina for corn, wheat, and other crops. This company does not have a small footprint, 64,000 hectares for rice in Uruguay. I think this slide really shows off the company well. They listed on the New York Stock Exchange here in 2011, and we can see that since then, their gross sales and total production has more than doubled. The land that they manage has been going up almost every year, and during this time, their earnings have increased massively. EBITDA is not my favorite metric, but we can see that it has roughly tripled since they went public. If you don't know, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And adjusted EBITDA could really mean anything, but typically when companies adjust EBITDA, they're removing things like share-based compensation. They might be removing the effects of certain hedges or derivative positions. Again, not my favorite metric, but profitability has increased really well over time. This has been a very well-run company. Now, you would think with growth like this that over the past decade, the stock has been a pretty good investment, but here's what the chart looks like. Let's go out all the way. Here, they went public in 2021, roughly $12 a share. Bounced up and down a bit, really crashed during COVID, but it's still trading for less than it IPO'd at. Now, when the price basically moves sideways over a long period of time while the fundamentals have just gone up and to the right, it means that the valuation of the company has come down quite a bit. The company relative to its fundamentals has gotten quite a bit cheaper. Now, maybe it was really expensive to begin with and now it's fairly valued, but for this company, when I look at the numbers, I think it's gotten simply too cheap to ignore right now. It has some short-term problems, which I think has given us the opportunity to get in at a decent price right now. We can see Google says that it's trading for a price to earnings ratio of almost 15, which you might not think is that cheap, but this is because their earnings in the short term have been greatly affected by their sugar production. There hasn't been nearly as much rainfall this season in Brazil, where they produce sugarcane, and that's a really profitable segment for them, and it's cut into their margins quite a bit. I think this is almost certainly a short-term issue, and this company is trading for, roughly 6 times a normalized version. We can see 2024 free cash flow was about $160 million. If you multiply that by 6, you get a number that's bigger than this market cap is today. There really aren't that many companies you're going to find in the market that are trading for just 6 times free cash flow that have this kind of growth. Just stable, solid companies that are going to keep producing year after year. And you know what? 5 years from now, 10 years from now, 15 years from now, people are still going to be eating. The demand for food and these products is only going to increase over time. I think also in a possible inflationary environment or in a recession, a company like this, a stock like this, is going to perform really well. It's going to hold up much better than companies that are highly correlated with the US economy. And just on its own, I think the stock is offering excellent expected returns from here. So moving forward, breaking down their sales, the biggest segment for them is this sugar, ethanol, and energy segment, but rice, dairy, soy, corn, all these other products contribute meaningfully as well. Now, they do have a bit of debt that's going to be coming due in 2027. This is definitely something to look at, but overall, the leverage on this company is not very high. For the sales and earnings that this company has, it's really not too bad. I think they'll be able to use some of their cash flow to pay down the debt a bit, and then they'll be able to roll over the rest, no problem. Speaking of how this company allocates their capital, I like that they're giving capital back to the shareholders. We're getting paid to hold this stock. They pay out roughly a 3.5% to 4% dividend at today's price, and they're buying back stock. Over the past 5 years, their shares outstanding have gone from about 119 million shares to now basically 100 million shares. So they're also eating up like 3-4% of the total share count every year too. All the while, they still have money left over to continue this growth that we have here. I mean, very quick back of the envelope calculation. We'll get into my model in a second. If we get 3 to 4% from dividend, 3 to 4% from the buyback, so that's like roughly a 7% yield right there. And then if earnings are growing, roughly 10% over time, with no multiple expansion from today's price, that would be roughly a 17% return. Again, this is a really quick calculation, but with such a stable business with lots of hard assets to give us a good safety net, I think we're getting excellent risk reward here. Even with whatever short-term issues, you see that they're anticipating returning $64 million to shareholders this year, which indeed is roughly 7% yield that they're giving us today when you add the dividend to the buyback yield. Now, if we look at who owns this company today, 70% is owned by Tether. 4% is owned by insiders. That's not bad. I like to see this number at least above, 2 or 3%. I want the insiders and management to have skin in the game and to be aligned with us as shareholders. Speaking of shareholders, only 22% is others. That's us. That's me. Now, just to show you what this used to look like, this is from the holdings as of November. Tether owned almost 20%, but then you just had a whole bunch of other institutional investors here. So between then and now, Tether bought out basically 50% of this company from all those other institutional investors. We see here Tether bought 49.5 million shares, so roughly half the company, for a price of $12.41 a share. That's quite a bit more than the stock is trading for right now. I mean, that'd be about a 33% increase from here. Today, us as little retail investors, we can buy this stock for 25% less than Tether paid for it. I think Tether made a decent deal. I just think that we're being offered a better one today. It is a little interesting that Tether bought a company like this. I mean, when I think of Tether, I do not think of agriculture. But I believe Tether said that no, they actually think the deal makes perfect sense. They think farmland has a long-term value. They think this might give them the opportunity to use USDT, Tether, their stablecoin, in actual real-world commodity transactions. And they think that having real assets will be a stabilizing force for their business. Now, getting to my model, let me update this so I get the most recent price. All right, we can see here that same revenue graph that the company showed off in their presentation. Now let's put some assumptions in and see what we can expect from AGRO stock going forward. I think my base case has pretty realistic assumptions. I'm assuming 6% revenue growth over time, which is a little bit less than they've averaged. I'm assuming 15% operating margins, which is lower than they have been over the past decade. I don't know why my sheet is pulling in the incorrect trailing 12-month number here. This should be about 10%. They've had weakness recently from their sugar segment, which I mentioned I think is temporary. It's seasonal. Also, for a company like this, where their revenue and earnings is really linked to commodity prices, you're going to see margins bounce around a bit. I mean, for McDonald's, the price of a Big Mac just basically goes up and to the right, kind of in line with inflation. But this is what sugar prices look like. I mean, you see, they peak, they go down. Commodity prices are very volatile, but I mean, in the long run, I believe that almost all these agricultural products, they're going to go up over time. It just won't be a straight line. If we look at the price of ethanol, another important product for them, I mean, they had this huge spike in 2022. It's down a bit now. So anyways, coming back to our model, I gave them a 9 times multiple 5 years from now, which I think it's fair. It's roughly where they've traded at for the past 5 years. It's a little bit on the low end for where they've traded in the past. I think for a solid, stable company like this, it's a little bit on the conservative side, but nothing crazy. And if all of these assumptions come true, you're looking at a 21% annualized return from today. Almost certainly, we would be outperforming the market, probably by quite a bit, if these assumptions come true. Now, in my bear case, which I think is a very pessimistic view of their future, I have revenue just growing at about 4%, so kind of in line with inflation. Either operating margin at 12%, which this would be basically lower than they've been at any point in the past decade in the modern history of this company. I gave them just a 7 times multiple, which would be dirt cheap. And if all these assumptions come true, which again, this is my like really bad scenario case, then yeah, you would be losing about 2% of your money every year for 5 years. So you'd be down a little bit on your money after 5 years. Now, on the flip side, if they just keep growing revenue at the pace that they've been at, roughly 7%, And if they keep operating margins at about 18%, which is actually on the low side for where they've been in the past decade, and if I just give them an 11 times multiple, which just for reference, companies like this in America are trading for roughly 12 to 18 times. So I'm not giving them some big valuation here. And if these assumptions come true, you're looking at a 36% annualized return for this stock. That would be absolutely fantastic. Overall, I think the risk return is excellent. This is why I bought this company. This is why I think Tether bought this company. But if you're looking at this video in the future and the price is different than it is today, you can see what I think your annualized return is going to be at different prices if our base case comes true. So remember, that's these assumptions here. 6% revenue growth, 15% margin, 9 times multiple. If the stock in the future drops down to $7, you're looking at close to a 30% implied annual return. If that happens and nothing significantly has changed about the company, nothing has changed about my thesis, then I will probably be buying more. This isn't financial advice. This is just my opinion. I'm not telling anyone else to go buy this stock. I just think the risk reward is looking really good today. And if you got something out of this video, subscribe to the channel. We recently passed 150 subscribers. I know it's not much, but thank you to everyone who's tuned in, who's watched the video. Leave a comment. Let me know what companies you want me to look at next. And I hope to see you in another video.